Hey everyone, this is the second in a series of screencasts that I'll try to do over the course of the semester. Again, this is for Accounting 3800, Understanding Financial Statements, summer of 2019. It's hard to say. Wow, it seems like just yesterday I graduated from high school and now we're in 2019. And I graduated from high school quite some time ago. At any rate, let's take a look at Chapter 1. I want to talk about that for a minute. Chapter 1 in Fraser and Ormiston, it's about financial statements in general. It kind of gives you a broad overview. All of you have had Principles of Accounting 1, and I don't know how far back your particular experience was, but it's always good to go back and kind of review things. And so what I did is I was actually up on campus yesterday, and I'll be back up there again today. And I was playing with the new smart boards in the classrooms in Memorial Hall now that it's been fully renovated. They're not quite finished yet. There's a few things they got to iron out, but the smart boards in the classrooms are really, really nice. And so I was experimenting with recording some things off of it. And so I kind of just put together a real simple overview of the financial statements. And believe it or not, this is as easy as it gets. So our basic equation is assets equals liabilities plus owner's equity. So that is the accounting equation, or what they refer to as the balance sheet equation. And because it's an equation with an equal sign, that means it's a balancing act. So your assets, everything you own or control, has to equal what you owe to others and what's been put in by the owners. So if you think about it, that makes a lot of sense. You had to get the assets from somewhere. Okay, they couldn't just mystically appear, and so they had to be purchased. And so in order to acquire these assets, funds had to be spent or expended, debt had to be taken on, cash needed to be raised. And so that cash comes from either people loaning you the money or people investing in you. And so that's where the liabilities and owner's equity shows up. So under assets, the way you could think about it is that there are cash assets and non-cash assets. So with cash assets, that's pretty much your cash and cash equivalents. Okay, it's the top item on the balance sheet, the top line. Your non-cash assets are everything else below that. And so you can divide them up into current assets and non-current assets. Again, current assets are those assets that are available within the year. Non-current assets are those that have a life longer than 1 year. So things like accounts receivable and inventory are items that you expect to turn over several times during the course of a year, and so those are current assets. Non-current assets are things like property, plant, and equipment, and then your longer-term investments. So cash that you have sitting around that you don't want to just leave sitting around in, say, a minimal interest savings account or some money market or something along that line. You'd want to lock it up for a longer period of time and have the opportunity to raise more cash through interest on those investments. And so you lock them up for a longer period of time. So those are examples of different types of non-current assets. So on the liability side, there's really just a couple of things that show up on the basic liabilities column. And that would be your current and your long-term. Under current, you've got different types of payables. The most common one you run across is accounts payable. Those are trade payables or payables to suppliers and vendors, folks that you do business with that provide you with what you need to do your business. Okay, you can also have things like salaries payable and rent payable, and companies have lots of different payable accounts, but generically we refer to them as accounts payable. Under long term, we typically have either notes or loans payable and bonds payable. Now there is a current portion of those, Typically, you're going to record for like notes payable or loans payable, any amounts that are due within the current year. Those are going to be listed under current. You could also have short-term notes as well. Again, the 1 year dividing line is critical. So if it's going to be something due within the year, it's current. If it's something due beyond the year, it's long-term. On the owner's equity side, the way you can think about it is that there's two sources of capital for owner's equity. The first is contributed capital. That is the funds that investors give to you, that you put into the business yourself, your partners may have put in, or other shareholders have put in. And typically, if it's a corporation or a corporate form of business, what you're going to have is you're going to have common stock. And we'll just deal with common stock. We won't talk about any other things. But just think of a share of stock as evidence of ownership, but not ownership in the typical sense. Having a share of stock does not entitle you to be a decision maker in the company. All it does is say that you have a share in the profits and losses of that company. The additional paid-in capital is an account that's used when somebody pays more for the stock than its par or stated value. So oftentimes common stock will have a par value, say $1. And so if I paid $2 for that share of stock, $1 would go into common stock, $1 would go into additional paid-in capital. Earned capital, well, that's what you acquire as you operate your business. So if we were to manufacture, say for the sake of arguments, we manufactured pillows, okay? So like the guy up in Minnesota that makes those special pillows that are supposed to be so good for your sleep. Anyway, earned capital is what he gets from selling those pillows. So essentially, that's where the income statement ties in. So you've got your revenues and expenses. Revenues minus expenses equals net income. Net income is your earned capital, and it goes into something called retained earnings. Out of those retained earnings, you can pay dividends to shareholders. And so that is a reward. That's the what they were hoping for as part of their investment. So in a publicly traded company, on a national exchange like the New York Stock Exchange, shareholders are looking for both the appreciation and value of their shares, but they're also looking for the receipt of dividends on a periodic basis. And so that's where that comes out of. A company is able to pay dividends if two things are true: if they have retained earnings and they have cash. You can have retained earnings and no cash, in which case it would be hard to pay dividends. And if you're not making money, in terms of if you're not showing a profit, because again, there's a difference between profit and cash, because we deal with the accrual accounting world. And in the accrual accounting world, we have stepped away in the short term from the cash basis of accounting, where we count everything as either cash receipts or cash payments. We ignore transactions that don't involve specifically the transfer of cash, either to us or away from us. The accrual basis of accounting looks at transactions from an event perspective. When has a transaction occurred? When has ownership or control changed hands? When have you actually incurred an obligation? So those kinds of questions come up with accrual accounting. So again, assets again are cash or non-cash, current or non-current. Liabilities are current or long-term. And then owner's equity is contributed capital and earned capital. So that's kind of important to make sure that you understand that. And the other thing to understand is that, again, this equation always has to be in balance. So if you have a transaction, say you acquire inventory on credit. So when you say on credit, it means that you are incurring a liability. So I'm increasing my inventory account, which is an asset. And that means if I'm increasing my assets, something else has to happen on the other side of the equation. So on the other side of the equation, what you have happen is you have an increase in your liabilities, your accounts payable. Okay, that's the way this works. If you needed more cash and you contributed more to the company, well then of course your common stock and additional paid-in capital would go up, and then your cash account would go up, and everything's in balance. Okay? So again, this is just kind of a review. I'll do a couple of these where I'll look at some concepts and kind of review them. I don't want to labor on the point. I want to keep these things down to about 15 minutes. So a couple of things to point out. One of the things you really need to know is when you're looking at accounting, and particularly when we're looking at accrual accounting, and what's really important. On page 16 and 17, the authors go through the characteristics, assumptions, principles, and basis of accounting. And so things like materiality, comparability, consistency, the going concern assumption, the two different bases of accounting, accrual and cash, and then the revenue recognition principle and the matching principle. Those are all important concepts that you need to really understand to kind of get a sense or an understanding of what accounting is really about. Again, it's not a perfect system, but it is the one that we have. It seems to be the best one available. I don't think any system for measuring performance for a corporation or a business enterprise is going to be perfect. And so I think this is the best we have at the present time. So as you're going through the chapter, make sure you really focus on understanding the core concepts that are being described. On page 18 in chapter 1, figure 1.4 gives you a pretty good example of accrual versus cash basis accounting. The authors kind of describe it as a maze, and I guess it can be. Those of you that are working through the first assignment, the introductory assignment, where you're looking at the Mattel 10K report, you might think that maze is probably pretty appropriate in terms of describing it. And so again, we'll take that up. We'll have probably a video where I'll go through that assignment and talk a little bit about the organization and structure of the 10K once you've had an opportunity to kind of go through it yourself. Okay, let me see. I think there was one other thing I wanted to mention, and that would be figure 1.3. Figure 1.3 on page 13. It's a description of the management discussion and analysis that's found in the 10K in the annual report. This is where management gets to express their views on how the company did. They get to explain the results in their own words. And so, one, you have to take it with a grain of salt because it is management's perspective. And, you know, some companies and some management are better about maybe telling it like it is than others. But everybody wants to put things in a positive light. And so you have to know that going in when you're reading MD&A. But there's a lot of valuable information in there. They talk about internal and external sources of liquidity. They talk about material deficiencies in liquidity and how they'll be remedied. And when we talk about liquidity, it's about how quickly we convert things to cash. How quickly can we get our hands on cash? Because ultimately, cash is what we need to pay our bills, pay salaries, vendors, pay our loans, all that kind of good stuff. So being liquid is important. Commitments for capital expenditures. They want to know like the purpose of the commitments and the expected sources of the fundings. And capital expenditures are expenditures for your non-current long-term assets, things like your property, plant, and equipment, or maybe some intangible assets like a patent, a copyright, or a trademark, something along those lines. That's going to be a productive asset for your company into the future, something that's going to help you generate revenue. So if you're going to purchase it, they need to know what's the purpose of it, and then where are you going to get the funding to purchase it. And then anticipated changes in the mix and cost of financing resources. And so this is kind of the balance between how much debt do you take on against the equity that is in the business. That's an important measurement there. So how much do you want to borrow as opposed to how much do you want to use your own money? I mean, think about it in managing a household. If I'm going to go out and buy a car, I have to make a decision. How much cash do I want to put down versus how much of a loan do I want to take out on the car, because the loan payment that comes in every month includes that ugly thing called interest, and that's the profit that the person who loaned us the money is going to make on us. And that is an amount we don't really have any control over that, and so we want to try to minimize that if we can. But you've also got to evaluate what you can use that cash for other than the purchase of the vehicle. Is it possible for you to take your cash, put it into something else, and earn more money than what you're going to be paying out in interest on a loan? Then it might make more sense to hold on to the cash, invest it, and then take out the loan for the vehicle. Okay, so those are kind of some of the decisions that get made, and those are the types of things that get disclosed in MD&A. Things like unusual or infrequent transactions that can affect income from continuing operations. That's kind of important, because when you're looking at the income statement, there are things in the income statement that occur that are one-time deals or one-shot deals, or only happen every once in a while based on certain events or circumstances that arise. But that the normal course of business generates a certain amount of net income and cash flow. And so you want people to be able to figure that out. And so you're going to want to divulge as much information as possible about those unusual or infrequent transactions that occur. And then anything that is material in terms of the relationship between costs and revenues. So you want to be able to talk about that. And then breaking down sales by price and volume components. Like, if sales went up, why did they go up? Did they go up because people were buying more? Or did they go up because the price went up? That's important to be able to know what contributed to either increases or decreases in your total sales. Okay, so those are the kind of things that they're going to talk about in MD&A, and that's kind of important to get out of the chapter as well. Because if you're going to do a financial analysis, that's going to be one of the sources you're going to use for information. Of course, always remember the notes to the financial statements are integral to reading the financial statements themselves. You cannot read the financial statements without considering the notes. And then, of course, MD&A will provide some context to go along with those financial statements and those notes. All right, so I'm going to sign off. I went over a little bit of my time here. But at any rate, hopefully you guys find this helpful. Again, I'm going to work on some more of these that I can post throughout the 8-week term to kind of help you understand and navigate through the material.